Statistics show that on average, over a 10-year rolling period, 10% of mutual fund outperform the S&P 500.
How do you then measure your own success as a CIO? Is that through the performance or is it something else?
Oh, there's a variety of measures. We measure our portfolio against peer groups, It's not so easy in wealth management, In asset management, products are categorized by asset classes, strategies, etc. So they compare directly against each other. In wealth management, you have some client-specific requirements. You have a variety of, we mentioned in a previous edition, suitability, tax angle, etc. So it's a bit different. But we do have some solutions where we're comparing apples with apples. For instance, the Julius Baer strategy funds are directly comparables with their peers implemented in similar fund formats, UCITS, which are all subject to the same rules and regulations and tax and suitability constraints. Therefore, we have some data points where we can measure in a fair and objective manner your investment track record relative to peers. It's easier for us, of course, in pure building blocks when we manage equities or when we manage fixed income, for instance, in the JB funds or in individual clients' accounts. There we have a very objective, undisputable performance comparisons.
So in the last episode, we talked about your strategic asset allocation, your tactical asset allocation. We're talking about, performance today. Can you hedge to protect that performance?
No, we don't hedge to protect performance. We hedge if we believe markets are at risk, and we have to have substantial reasons to believe this. It's the four-market regime approach. We hedge risk in portfolio to various degree if we have that evidence. If we don't, we stay the course along our strategic allocation objectives, and we focus on managing the respective asset classes and, very critical, extremely strong portfolio construction. And I'd like to say a word about this. The sum of the part is more important than the individual parts in a portfolio. If you look at the track record, and there have been some empirical studies on the topic. For instance, let's take probably one of the most competitive markets, one of the benchmark that is the hardest to match or beat with an active investment approach. Obviously, US large cap equities, best illustrated by the S&P 500 index. Statistics show that on average, over a 10-year rolling period, 10% of mutual fund outperform the S&P 500, 1 out of 10. The additional problem is, by the way, the next 10-year period, it's also 10%, but not the same. And the next period is also 10%, but those of the previous periods have retired, so you don't know if there will be stability in the performance track record. Jokes apart, interesting is to analyze how that performance was produced. Analyze the profit and loss of those mutual funds. And the remarkable finding of those studies is that the hit ratio of those managers is close to 50%. Meaning, essentially, when they buy a stock, it's like flipping a coin. 50% of the time they're right, 50% of the... So people would then ask, how come they beat the market being right only 50% of the time? Yeah, they beat the market because they have asymmetry in their return. In other words, the winning trades win more than the losing trade lose. And it is that asymmetry that creates the excess return over time.